been a lot of discussion on the panels. There's a lot of media coverage on capital in Southeast Asia, or the lack thereof. And so I wanted to use this time to talk a little bit about why that's happening. I don't think that's been written about or talked about enough. And so I'm going to spend some time kind of going through that. And I'm going to break that into a few sections. One is a market update, exits and liquidity, and then a little bit around AI. And I think ecosystem is exactly the right word to use. There are lots of ingredients that come together in order to form a tech ecosystem. There's founders, there's talent, there's innovation, there's markets, consumers, SMEs, enterprise. But there's also capital, and capital underpins most of the growth and most of the advancements. And so if it's not there, everything starts to slow down. And I'll go through the market update and also give you a little bit of background about myself. So I've actually been investing in Southeast Asia for 26 years. I was obviously 8 years old when I started. That's a joke. But no, when I started in 1999 at Yahoo, I originally started in M&A. There were 2 million internet users in Southeast Asia. And every year, there was a small increase and a small increase. And in 2011, I joined TPG Capital to do private equity investing. And when I was at Yahoo, I was fortunate to spend quite a bit of time in China. We invested in Alibaba in 2007, moved to Singapore 18 years ago. We actually acquired Koprol here in Indonesia. It was the first acquisition of a Western internet company in Indonesia. And then went to TPG and was fortunate to work on deals like SurveyMonkey, Uber, Airbnb, Lenskart, Property Guru. And a lot of people ask me, why did you leave private equity to go into venture? And it's really part of it, I have great partners at Jungle, but part of it is that red line. It's just, it was a phenomenal amount of growth that was happening, and that's new users coming online. And when you think about new users coming online, there's a lagging curve, which I would call trust and confidence. And once you come online and you build trust and confidence, then consumption starts to happen. Monetization starts to happen. Now flash forward to today, and we've got nearly 500 million users online in Southeast Asia. And so we've proven now that we have a market of real scale. It's complex. So Southeast Asia has always been a region of complexity. Every country, different language, different currency, different regulatory environment, different cultural norms. But that inherently also helps to create moats for businesses. So that can create opportunities for startups to create some defensibility around what they're doing. And we've also now proven that there are mature, large businesses that we can build in this part of the world. And so I've cut this into 3 different sections. There's a cohort of companies from 2009 to 2012. They weren't really part of the venture ecosystem. So Anthony at Grab always says that his mother led his seed round, which is absolutely true. Gojek did raise a Series A from a venture backing, but a lot of the companies didn't raise from venture. So venture really only started to get formed in 2011, 2012 through 2015 was the first group of VCs that really kind of came around to invest in early stage. And then you also have a cohort of companies which are really 2013 to 2016, which are really the first group of real venture-backed startups. And those companies are now reaching a significant level of scale across the region. And I didn't include all of the VCs. There's 500 startups, there's Wavemaker, there's lots more. Obviously, lots more companies, but just to give you kind of an indicative view of the region. I think, but the proof point that we've taken away is that we can build very large businesses, and we can do that in what's a quite normalized time scale. So if you think about all the companies that have gone public on NASDAQ this year, the average time it's taken them to get from a Series A to go public has been 12 years. The average revenue for those companies is about $900 million, about $1 billion today. The shortest one was Figma. So Figma went 9 years between Series A and IPO, and the longest one was StubHub, which was over 20 years. And so if you think about Grab and SEA, 13 years and 16 years respectively, those are actually quite normal time spans in order to build the level of scale that they've gotten to today. And so we've proven that we have a market. We've proven that the market can build very large, scalable businesses. And we have a group of companies that are coming up behind those, which are actually very, very interesting. If you think about valuations, unfortunately, valuations haven't mirrored the US and China. And so this is 4 companies, all in the mobility space, all of their valuations within the first 5 years of starting. And I apologize, it says millions, but it's actually billions that are on there, so that's a mistake on the slide. But there is a 10x difference between Uber and Grab in the first 5 years in terms of their post-money valuations. But there's not a difference, really, in how much capital they were able to raise. And most importantly, who they were actually able to raise it from. So BlackRock, Google, well-known private equity firms, they all invested in both of these companies. Both companies raised a similar amount of money, but valuations were very different. And part of that is due to the size of the market. Part of that is the perceived risk of execution within Southeast Asia. And part of it is the long-term scale. And so now, if you compare Uber, in Q2, Uber did $12.6 billion in Q2 versus Grab at $800 million. So it's a very different level of scale. But I think the thing to take away is that their trading multiples are actually quite similar. So Grab is not trading at a discount, it's actually trading at a premium to Uber. And part of that is how analysts in the market thinks about where growth can come from. And I think with Grab, they're more excited about advertising, they're more excited about Fintech, they're more excited about the amount of growth that they can get off the current base, and so they're getting a slight premium. But I think that's also great to note about late-stage companies in this part of the world. But the most important thing is that capital has to be circular. And so if you think about from a fund's perspective, we go out and raise money from our investors, which are called limited partners, or LPs. We invest that capital. Hopefully there's value that's created in doing that. And then we exit and return that capital with the profits back to the investors. And if you're not able to exit and drive that liquidity back, then after a few years, the money stops coming in. So in a lot of the funds, like we're on our 5th fund now, but a lot of the funds in Southeast Asia are on their 3rd fund, their 4th fund, their 5th fund. And so if you didn't return capital from Fund 1 or Fund 2 or Fund 3, then your ability to go and raise Fund 4, Fund 5, Fund 6 starts to get hampered. And so if you can't get the new capital to come in, then you can't raise a new fund vintage. You can't invest in more companies. And that's kind of where Southeast Asia is at the moment. And so most of the region is very heavily focused on trying to drive that liquidity and not let the flywheel start to slow down. And you see that in the numbers. So this is the Cento report. So it's a 6-year low. Deal making, because there's not as much new capital coming in, has become super selective. Less investments are getting made. The bar for raising capital has gone much higher. And then you're also going to see a lot of noise in the numbers. And so in 2015, 16, 17, Singapore was a place where a lot of companies came to domicile their business, particularly out of India. And so when those Indian companies set up as a Singapore topco, whenever they raised money, that filing went through ACRA, and then it got reported in the media, and that was a part of Southeast Asia fundraising. Well, now a lot of these companies are re-domiciling back to India. So originally that process was very hard, very complex, but India's actually streamlined that process now. And so Times of India had an article where 40 companies have now re-domiciled from Singapore back to India in order to go public in India, which is $90 billion in equity value. And so those numbers and these companies are not going to be reflected in the region's numbers. And so you're going to see quite a bit of noise in terms of how the recovery looks. And so it needs to get normalized against some of this. This is the latest DSA Kickstart report. I think the interesting thing to note here is that late stage investing is actually coming back. And the interesting thing there is that most of that 2012, 2015 cohort of companies which have been coming through, most of them are at scale, most of them are profitable, most of them are thinking about when they should be going public, and so they become a very attractive investment opportunity for private equity, for crossover funds, for hedge funds. Aaron from Caro was on the stage yesterday. I think he made some really insightful points around secondaries and how important secondaries are. But we think that's a trend that will absolutely continue into Q3, Q4, and then the first half of next year. And so I think you're going to see the late stage recover a lot earlier, which again helps the whole ecosystem as a whole. And then from a public markets perspective, we'd always kind of hoped that the SGX would be the normal place for companies to go and list when they got to scale. Unfortunately, the SGX has been in years of negative growth. So in 2024, they had 4 listings, but they had 21 companies delist in Singapore. And so you have less companies public today. That was the same trend in 2023. The government in Singapore is doing a lot more to encourage listing and encourage tech companies to list in Singapore. But I think that'll take a long time for a lot of that to play out. I think the IDX, the pipeline is building. So there's a few companies that have announced that they will go public in Indonesia, which I think is great. So the more companies that we have, the more of an index you start to build, the more interest you start to attract from foreign investors. That drives liquidity. Also turning on things like shorting here and on the IDX also helps drive liquidity. And then obviously you have NASDAQ, so SEA is listed on New York Stock Exchange, but you have NASDAQ and New York Stock Exchange. That's really the gold standard, I think, for tech companies. But you really have to be of substantial scale. And so you really need to be in that 3 billion valuation and above. But I think you'll also see more and more companies in Southeast Asia achieve that level of scale and start to go public in the US. And these two, SEA and Grab, I think are really trailblazing the way. They're educating the market about Southeast Asia, the dynamics of this region. SEA in particular, I think, is proving that companies that are based here can actually become global players, that it's not just a regional story or an individual market story, that you can actually expand globally and build much larger platforms out of this region, which I think is also very interesting. Liquidity, just for your benefit, for venture investors, tends to come in 3 ways. So companies don't have to go public. There's a lot of benefits of going public. So SEA and Grab have both raised bonds as public companies. So that's a much less dilutive source of capital to fund future growth. But exits can also come from M&A, where a whole company is acquired. In Southeast Asia, that's really happened at a smaller level. So most M&As have been below 100 million in total value. But we've had some great buyers in this part of the world, from Intuit to Twitter to Alibaba. And a lot of US and Chinese companies, I think, continue to think about buying their way into this region, partially because it is such a complex region to operate in. It's easier to come and buy a team that already understands the operating complexities and can scale up from there. And then, like I said, there's also the secondaries. So I think secondaries are very interesting for founders because you don't want to be in a position where you want to raise more money, you want to fund growth, but everyone sitting around the table, your existing investors, don't have any more capital to invest. And then you're having to go out and pitch new investors. Secondaries are a way to exit out some of your early stage investors, bring on new investors onto the cap table who potentially then go and invest more capital in the business and continue to help you grow through that next phase. So for founders, There are lots of founders that never want to sell their company. They never want to take it public, but they're going to build a very big outcome. If you think about Canva in Australia, that's a very good example of a company that may or may not go public, but they've created lots of liquidity events along the way for early stage investors. And the Australian ecosystem has actually benefited hugely from Canva and their secondaries, because a lot of that secondary money went back to angel investors, to high net worths, who are now investing in the next group of companies coming through. So a lot of that gets recirculated again, even at an angel level. And so as a founder, what can you be doing? I think you can always be getting ready and thinking about this. So if you're a venture-backed business, you should be thinking about the investors that I have. They're working on a time scale. And all funds are usually 10 years, and then with a 2-year extension. And so at some point, your investors are going to come and say, it's time for me to exit. So you don't have to sell the business, you don't have to take it public, but we do have to create a liquidity event for some of the early stage investors. And so that should be top of mind for you. It should be part of your planning. And then again, it's, a lot of it is an ongoing, so data hygiene, that's one thing that we do with a lot of our companies. So as you think about constructing data rooms and making it easier for new investors to do diligence, that should just be an organic process. So every time you hire a new employee, it goes into a data room. Every time you sign a contract, it just automatically goes into a data room. And as you're building the business, you're just building organically that data room. In terms of Jungle, I did want to talk about some of the themes that we're quite interested in. Obviously, 2024 was a watershed moment for AI. It went from novel to necessity. It's pervasive. It's ubiquitous. You see it everywhere. I was on an escalator in a shopping mall, and the woman in front of me was searching on ChatGPT and not Google. I think it's just indicative of how much it's driven into society today. Agents and agentic platforms, I think for a lot of investors, feel very commoditized. It's a GPT wrapper to something. But I think historically, in our experience, whoever is closest to the customer always has the opportunity to build real value. And so you can build real value if you're touching that customer experience. And we see no reason why that should change in a world of AI. But software is also unlimited today. And so you really need to identify defensible positions that you can get into. And defensibility of what you're building, I think, is going to be one of the biggest questions. SaaS, over the last 15 years, has gone from $13 billion to almost $200 billion worldwide. And yet revenue per employee on the S&P 500 has barely moved. And so even though they've adopted software, the efficiency hasn't necessarily flown through the organization. And a lot of software has fixed siloed issues, but actually created a lot more complexity within organizations. I think AI has the ability to change a lot of that across the enterprise. But I think you really need to be picking categories that you have a deep understanding around, you understand the workflows, and you understand the problem sets and how they can be solved. And what you're doing is quite defensible and can layer on top of existing workflows, so you're not asking people to change everything that they're doing to adopt it. So some of the categories that we think are most interesting is healthcare. Obviously, I think everything goes personalized with healthcare and medicine. My body is different than your body. My history is different than your history. So the ability to collect as much of that personal data and then let that be informative in terms of diagnosis or treatment going forward. So I think in this part of the world, there's just a lot of disparate data sets that are there that can start to be collected. Data tokenization is really the exchange of information between agents. And so in the future, there'll be lots and lots of agents that will serve enterprise, that will serve you, and the exchange of data between those are being controlled by tokens. And the approval to exchange data and what they're allowed to do, there'll be a lot of infrastructure that gets built around that tokenization. The speaker before talked about climate change. I think that's a very interesting space, particularly in energy in this part of the world. And then vertical applications, we talked a little bit about the GPT wrappers. And so in 26 years of investing in this region, despite some of the capital constraints that exist today, I still think it's one of the most exciting times to be building a business. And just wish you the best of luck. If you have any ideas, please come and talk to us. Thanks for your time.